Good morning. I want to welcome everyone participating in this morning's webinar. My name is Yevgeny Suhenko, and I'm a supervisor in the Outsourced Accounting Department at Gelman, Rosenberg, and Friedman, and I will be today's moderator. We'd like to start off today with a few quick housekeeping items and explain what everybody needs to do to earn CPE credit for today's webinar. So for the best sound quality, we highly recommend that you connect by phone instead of your computer. If you have any technical questions or issues or anything like that during the webinar, please use the questions function to speak with our webinar administrator for assistance. Please note that this webinar will be recorded and made available on our website following the event. The slides will also be posted at the address www.grfcpa.com/webinar. All webinar participants seeking CPE credit for this presentation must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. Please write down the CPE words when they're given, as they will not be provided again. You will also be asked to recall these words in order to receive the credit. If you have an active pop-up blocker, please take a moment and disable it now so that it does not block the survey. Any technical questions about the survey may be addressed to Dominic Acosta at dacosta@grfcpa.com. So as the title of our webinar implies, today's learning objective is to provide attendees with a better understanding of the impact of FAR Part 31.2 cost principles on indirect rates. 1.5 CPE credits are available to attendees of today's webinar. With that said, welcome again to everybody to today's webinar, Understanding the Impact of FAR Part 31.2 Cost Principles on Indirect Rates. This is part 4 of our 5-part GovCon webinar series co-hosted with SIMPAC. So today's speakers are Paul Calabrese, who is a principal with Gelman, Rosenberg, and Friedman's Outsourced Accounting and Advisory Services Group. Mr. Calabrese brings a successful track record of working with both nonprofits and government contractors. His remarkable career includes positions with the Air Force Audit Agency, DCAA, and 3 government contractors, in addition to his 20-plus years in public accounting. We also have Chris Brown, who's the president of Aldebaran and has 25 years of experience with the development and promotion of the SIMPAC software product lines. He has personally helped hundreds of government contractors achieve compliance through the use of cost accounting software that's purpose-built for the government contracting industry. And finally, we have Steve Shamlian, who's the founder of Government Contract Compliance Management, LLC, a firm dedicated to providing high-level government contract accounting and pricing services to both mid-market and emerging government contractors. Steve has over 30 years of experience serving government contractors of all sizes in a wide variety of industries. Steve's experience has come from his work in government, specifically the DCAA, industry, and consulting. And before we begin and jump in, we'd have to go over our first polling question. And the first question is, what is your knowledge level of FAR Part 31.2 cost principles for government contractors? Is it about 25%, 50%, 75% or more, or are you completely new to this? So please take a moment now to put in your responses. While everybody's recording their answers, I'll provide the first CPE word. The first CPE word for today's webinar is audit, A-U-D-I-T. Remember, if you want to receive CPE credit, please jot these words down as they're given because you will need them for the survey following today's webinar. Again, our first CPE word is audit, A-U-D-I-T.
You speak. Okay, we've got a range of people here. But including 30% who are new to this, and 30% that are a little bit of experience. So we'll try and address your needs of all of these things. Anyway, moving on, we're to FAR Part 32 31.2, we're going to be discussing. We'll be discussing allowability and the criteria for determining allowability is stated in FAR 31-201-2. It's the cost principles that we'll go through in just in a few minutes. ALEC Ability, so the costs have to be properly allocable to the contract. Reasonableness, costs have to be reasonable, and there's a criteria for that. One of the criteria that's not listed is, do I want to see this on the front page of the Washington Post? Cost accounting standards, many of which are incorporated into FAR Part 31, and specific terms and conditions of the contracts. We'll be addressing selected cost principles that during the course of this, and if you have any questions, please please ask. There's a category of unallowable costs called expressly unallowable cost, and we'll address that also. I like to start all my presentations with a risk assessment. What could possibly go wrong under these circumstances? So you have a contract that's subject to the cost principles. So what? What can happen to me as a result of having this this clause that subjects me to the cost principles in my contract? Well, let's look at some of the big issues associated with that. First of all, allocation bases. Both FAR and CAS allow contractors broad latitude in determining what costs they pool together in homogeneous cost pools and how those costs are allocated by means of allocation bases that bear a causal or beneficial relationship to the cost in the pools. Because there's a broad latitude available to the contractors should take advantage of this and make the cost allocation practices conform to the nature of their business. We'll discuss allocation a little bit more in a later slide. But cost allocation, because it's moving, material amounts of they're assigning material amounts of cost to cost objectives. Any errors or problems with an allocation base can result in a significant cost impact either to the government or to the contractor. Moving along to unallowable cost. CAS 405, which is incorporated into FAR Part 31, requires that unallowable costs be identified and segregated from billings to the government. More importantly, it requires that costs retain their original character as either direct cost, indirect cost, and components of cost allocation bases. So if a direct cost or cost that would normally be charged direct to a contract is unallowable, it remains a direct cost. If that cost is part of an allocation base, it remains a part of that allocation base. And so you'll say, if I include unallowable cost in an allocation base, that means a portion of otherwise allowable cost will become unallowable. And that's exactly correct. There's a bullet point here, the use of GL accounts to record expressly unallowable cost. You need to assess within your organization the competence of your staff and the staff's ability to identify a cost that is expressly unallowable and to account for it appropriately. The use of GL accounts is good and recommended. There's also other less formal means, memorandum records or other less formal less formal but auditable means are also appropriate to use. There are penalties for claiming expressly unallowable indirect cost. These penalties can be up to 300% of the cost, the expressly unallowable cost claimed. These are limited to costs that are specifically unallowable per FAR 31.2. Expressly unallowable costs are subject to an objective standard. So it's not just the whim of the auditor or the contracting officer. It's an objective standard that the contractor or any oversight body can assess on an objective basis. So for a cost to be expressly unallowable, the government must show that it was unreasonable under all circumstances for a person in the contractor's position to conclude that the costs were allowable. So the cost principle states in direct terms that the costs are unallowable, or leaves very little room for differences of opinion. So the cost of alcoholic beverages are unallowable. That's very direct, leaves little room for interpretation. The cost principle is identified the specific cost or type of cost in a way that leaves little room for interpretation. And there are cost principles like the advertising cost principle, which specifies types of advertising that would be unallowable. Generally speaking, types of advertising that are self-promotional would be expressly unallowable. There is some DCAA guidance that's referenced here, MRD 14 PAC-022, which is a very thoughtful piece of guidance from DCAA that talks about an objective standard and the cases supporting that. There's also an MRD 14 PAC-021, which is a list and really not very thoughtful, but certainly worth a read. And there's cases that have been decided in the past, and I'm sure there's going to be more, because this is an area that the government and regulating bodies and contractors are looking at and trying to find more definitive guidance. We talked about some objective principles. Here's some principles that are not objective. The cost was unreasonable. Well, what does reasonable mean? There's some criteria, but there's also some application of those criteria, which are subject to the individual's making the determination, and not an objective standard. The costs are not allocable. There's broad range in what constitutes allocability, and it's just not an objective principle for this purposes. Not in accordance with terms of a contract. This may be an objective principle. However, the penalties apply only to expressly unallowable indirect costs. So the contract, so direct costs are not subject to penalties for expressly unallowable costs. Any other subjective criteria, you'll find in FAR 31205-6, it talks about bonus plans. And bonus plans have to have a company policy implementing the plan, or a practice followed so consistently as to imply a policy that of paying a bonus. This practice followed so consistently, that's a pretty subjective criteria.
Well, from year to year.
Yeah,
if it's consistent from year to year, yeah, that is implied.
That seems to be. How many
and
years?
You set, and you, at least one or two. And
if I do it once,
and you accrue it for the, and pay it the next year, and every, you accrue it in December as an example. You're always paying it in January, February. Yeah.
So reasonable people can disagree as to how many bullet points it takes to create a practice followed so consistently. And because could be differences of opinion on that, it's not an objective criteria. This is kind of, in my mind, a little odd. It requires an application of criteria beyond the cost principle. So the cost principle can state that penalties, as defined in Internal Revenue Code, are unallowable. That seems to be pretty objective. But it's not expressly unallowable because it requires a criteria beyond the cost principles contained in FAR Part 31. Many of the cost principles do not provide a direct statement or provide ALEC Ability criteria, in which case those are not standards that are for expressly unallowable cost.
I just want to add that I think most of us were a little frustrated because the auditors come in, and I think even if you read the generally accepted government auditing standards that talk about audit judgment, it's everywhere. We're human beings. So are the auditors. The auditors have a certain prejudice or filter. You have a certain prejudice or filter. So some of these things are not so clear just simply because we're human. We want to make things consistent. We want to make things so it's kind of black and white, but what you've gone over is there's a lot of gray.
There's a lot of gray, and you shouldn't penalize somebody. It's not good policy to penalize somebody because they were operating within a gray area.
Right.
Yeah. And so we're just pointing out that when the area is gray, then penalties on unallowable costs are not applicable. Here's the other DCAA guidance that I mentioned, Memorandum to Regional Director 14 PAC 021. It's a list. It's not very thoughtful, but it's worth a read and worth looking at when you're preparing an incurred cost submission. This DCAA guidance is found on their website under Guidance and Memoranda to Regional Directors. It's there on the internet, and you can look that up. You're required under FAR Part 42 to certify your final indirect cost rates. It's required that the person signing be a vice president or CFO of a segment, executive management, and certifies that expressly unallowable costs have been removed from the submission. This holds the contractor to a standard of due care in preparing the final indirect cost rate submission. There are cases that address that, and the contractor should be aware of that. This is not an activity to assign to a low-level analyst, but should be assigned to somebody with the competence to be able to do this effectively.
Just want to add one thing here, and that is when you have an incurred cost submission that's been sent to DCAA and they do their initial adequacy review, say they find just one or two problems or many, then you are to recertify, meaning re-sign this thing again and redate it. And that will be the one, should there be no more adequacy issues, that goes forward.
In addition to unallowable costs, there are some directly associated costs. There can be directly associated costs that would be otherwise allowable. But any cost which is generated solely as a result of another cost, which would not have been incurred had the other cost not been incurred, is a directly associated cost. Let's take an example. If your company has a lobbying department, lobbying is unallowable, but you've got a lobbyist on staff, so the cost of that lobbyist is unallowable. That lobbyist incurs fringe benefit cost. the fringe benefits associated with that lobbyist would not have been incurred had that lobbyist not been there. So those fringe benefits, the allocable portion of the fringe benefits associated with the lobbyist, are also unallowable. The lobbyist has an office, so the facilities associated with that lobbyist are unallowable. The lobbyist has an administrative assistant and a staff. Their costs are also unallowable as directly associated costs. A concept that also applies to determining allowable cost is that any credits relating to the applicable portion of any income rebate, or the applicable portion of any income rebate or allowance or other credit to any allowable cost will be credited to the government via an expense account as a cost reduction or a cash refund. For example, the sale of an asset. This asset has been, the depreciation associated with this asset has been included in an overhead account for the life of the asset up until the date of the sale. When the asset's sold, there's a gain associated with that asset. That gain also needs to go to the overhead pool where the depreciation was claimed, and that way the government participates in the gain associated with the allowable cost of the asset. Important thing to point out in this is that the credit applies to the allowable to any allowable cost. So if you have a credit, if you have rental income of $1 million, but the cost of the building is $500,000, the applicable portion of the credit is up to $500,000. ALEC Ability is a criteria for allowability, and ALEC Ability is a cost that is assigned or chargeable to one or more contracts on a basis of relative benefits received. It can be incurred specifically for a contract, like direct labor or direct material. It could benefit both the contract and other work, like overhead cost. And overhead cost is distributed in a reasonable proportion to the benefits received. For example, via direct labor dollars, machine hours, direct labor hours, etc. Or it's necessary for the overall operation of the business, though no direct relationship to a particular contract is observed. This is G&A cost, and it's allocated over some measure of business activity. And that measure is typically total cost input, but may also be value added or some single element that represents the nature of the business activity. For example, direct labor. We talked about reasonableness very briefly. Costs are reasonable when, in the nature and amount, it does not exceed what a prudent person in the conduct of a competitive business would incur. Is Apple a competitive business? And you'd say yes. Apple has historically had great Christmas parties with great entertainers and wonderful door prize. Is that unreasonable? Can you do it as a government contractor? Have a similar Christmas party, a party that would vie with Apple's Christmas party? Reasonableness is a subjective criteria, and there's a different standard for reasonableness for government contractors than there is for Apple computers. There's no presumption of reasonableness. So when the government challenges your cost based upon by stating that it's unreasonable, then the contractor has to support that it is reasonable. The contractor has the burden of proof.
Hey, Chris, you had something to say on
Yeah,
this.
I did actually. I was just going to chime in. Thank you. And basically, the way I look at this when it comes to reasonableness, yes, that is subjective. I could be the most unreasonable person in the world. I can go ahead and, be in conflict with everything that falls within those that realm. However, when you look at the costs that we're going to cover in detail momentarily, you put the shoe on the other foot. You don't want your vendors, I don't suppose, charging you for their luxury suite at a sports arena or alcohol that they have at their happy hours, and neither does the government. And it's really, when you look at it that way, you put the shoe on the other foot and you say, okay, what's reasonable, what's not reasonable? And there may be some areas that you don't necessarily agree with. But all in all, when you study FAR Part 31205 and go through what is allowable and what is not allowable, and you look at it from a standpoint of, okay, does that make sense? Chances are you're going to think, yeah, it does make sense. I think they're right about this, and it doesn't make sense for me to even consider trying to recoup those costs as part of my indirect rate structure.
I mentioned also that there's the front page of the Washington Post Standard, and that's there under reasonableness. Would you like this to be presented on the front page of the Washington Post, that your company incurred this type of cost that many people would consider extravagant? So, hey, contract terms. Specific contract clauses may restrict allowability or recoverability of certain costs. Contract terms can include, can make otherwise allowable cost unallowable. I've seen contracts that made interest cost or insurance cost unallowable because the customer, a city, was going to provide insurance for this particular construction project. There are not to exceed limitations on travel and material and other things that can be included in contracts. And then if the contractor exceeds those amounts, those costs are unallowable. However, they will still retain their nature as a direct cost of that contract. The contractor will not be able to bill those costs on that contract or on any other contract. Some contracts have burden rate ceilings. So if your overhead is limited to 100% and you incur 125% overhead, that difference between the ceiling and the amount and the actual is unallowable. Overtime premium is often limited. There's a specific government contract clause that limits that, subject to the contracting officer's approval. If you find that you're going to incur overtime, do your best to get the contracting officer's approval in advance. Pre-contract costs. Pre-contract costs are allowable, but to what extent? And so it behooves the contractor to have an agreement incorporated into the contract that addresses any pre-contract cost applicable to that contract and makes those costs recoverable. Also, there's limitations on fee. There's award fees and various other types of fee structures that can be specified in the contract, and recovery of that fee is subject to the terms of the contract and your ability and your compliance with them. We've talked about allowability and mentioned some high-level criteria and for determining allowability. In addition to those, a significant criteria is documentation. The contractor has to support his cost as allowable. Many of the big contract audit reported by the Inspector General have significant costs that were questioned because the contractor could not support them. Your accounting system should require documentation to support any cost that you're going to claim. You must retain the documentation for the required period of time, or the government can disallow them. And that the time specified in general is 3 years after final payment. However, there's another FAR section that provides some other criteria. 3 years is the rule of thumb.
All right, we're going to go into the individual cost principles, and Chris is going to start us off.
Yes, so effectively, if you are new to government contracting, chances are you're new to cost reimbursable contracting as well, and therefore you're probably unfamiliar with allowability versus unallowable costs, allowable costs versus unallowable. So this is a key point when you're, as part of the series that we've done, starting with, calculating your actual indirect rates, projecting your provisional rates for billing, and then truing up your actuals versus your provisionals during the incurred cost submission. One of the points we've made is that you want to keep your books as clear of unallowable costs as possible. So not only you, as presumably most of our audience today are either contract personnel or accounting staff, accounting and finance, not only should you become familiar with these costs, but in particular, expressly unallowable costs should be documented and disseminated company-wide, presumably in your employee handbook. All your staff should know about these costs. Now, in looking at this, I'll just give you a little bit of history of this. Brief history is that the Federal Acquisition Regulations, known as the FAR, has its origins in the Armed Services Procurement Regulations that were established in 1947. So this goes back 72 years. It was codified in Title 48, Chapter 1 of the Code of Federal Regulations as the Federal Acquisition Regulations, get this, on April 1st, 1984. So it just celebrated its 35th birthday. I don't know if it was a coincidence that they published this for the first time on April Fool's Day, but I think it can be said they weren't fooling around when it comes to Part 31, Subpart 205. Now, even though you'll notice that when you're going through these items, they're not organized in a way that you would expect. So it segues between each part or subpart of FAR 31205, segues between allowable costs versus unallowable costs, and then back to allowable costs. So, but the good news is it hasn't changed a whole lot in the last 35 years, but occasionally amendments are made via federal acquisition circulars. So that is where you'll find any changes or updates. So the takeaway here is, get to know this part of the FAR, especially, again, if you're in any kind of cost reimbursable or flexibly priced contracting, and make your staff aware of these as well. Your business development folks, for example, who are out on the golf course, get them familiar with these regulations. And when it comes time for your incurred cost submission, you'll probably be good to go. So with that, we've got a lot of ground to cover. We're going to talk about 38 of these in particular. Paul's going to lead the way on those. So that's just, again, the takeaway is just to get your mind around this. And once you do, it's going to make your job much easier when it comes to living in the world of cost reimbursable contracting.
All right. Thank you, Chris. I appreciate that. So we're going to go over these cost principles, or what they call the selected costs. And just for your knowledge, they were numbered up to 52, and I guess some have been reserved, and maybe one or two, like ADPE, was removed. So, and it's there are 46 now, and we're going to talk about 38 of them. And the reason we're not going over a few of them, like wind tunnels and things like that, or having a nuclear generator or something, whatever they call those, is simply because we're assuming most of the audience here is pretty much service with, if you have manufacturing, it's probably like manufacturing. So when I look at this list, I look at what are the three basic everyday things that everyone's going to deal with, and that's for surely compensation, which is number 6, which we'll go over, and professional and consulting costs, which is number 33, and travel, which is 46. Probably some material stuff and a bunch of others thrown in. But we just wanted to give you that sense of the being of the amount of this stuff and where to really focus your time. In this list, it can be a little bit of a cheat list because if you notice at the top, it says they may be allowable A, unallowable UA, or allowable with restrictions. So you'll notice like alcoholic beverages at the top there, it's unallowable completely, whereas let's just use something else here. Oh, okay, cost of money is allowable with restrictions. So there's some things that are allowable, some things that aren't. I'm trying to look at one that's 100% allowable, and we may have to.
Bonding cost.
Was it? Good, you got a good eyes there.
Good.
So bonding. So it's just like a cheat sheet to help you so that, you know, when you go through this, I will say probably one of the more complicated and fought over standards besides compensation is terminations. We'll briefly touch on that, but that in itself is a whole world unto itself. Okay, now we go through actually the very first, and that we know that advertising is unallowable. It's something that it's hard for the government to see as benefiting the government itself. They believe that that is really your responsibility. It's also part of what they call public policy, and the public policy like that and interest and a bunch of other things, you know, they're not going to pay for it. They feel they pay enough. So you know what advertising is, promotion of things. And I know that a lot of people sit here, and I'm going to challenge you today, and I think all three of us, Chris and Steve will too. There are some exceptions, weird exceptions, but there are exceptions. For example, there's something called direct selling expense, and we'll talk about it later. Under advertising, you know, building an exhibit for a trade show is unallowable, but you could build an exhibit and it just be a one-on-one relationship with you and the government, and it was to demonstrate might be allowable. So you're going to find there's all kinds of things, and there are exceptions to the rule. And of course, public relations, promoting yourself is unallowable. And I believe, Chris.
Yeah, there's one exception to that. Yeah. So next slide, when we're talking about public relations costs in particular, there you go. You know, the allowable exceptions to the rule would be the cost of press releases to communicate with the public, press, stockholders, creditors, customers, in order to keep the public informed on matters of public concern, such as a notice of contract awards. So if you win a big contract award, you want to do a press release to announce that. You want to announce your financial results, create a press release for that. You've just hired a Nobel laureate and you want to do a press release about that. Well, that's going to be allowable, that type of public relations.
Thanks, Chris. And of course, both of you gentlemen, please feel free to chime in at any point. We know that bad debts and the directly associated costs of bad debts, like having a collection agency and so forth, are unallowable. No need to spend a lot of time. Bonding costs is 100% generally allowable. It's something that you need to do to protect yourself, and the government wants you to protect yourself against financial loss, you know, in case you default or something bad happens against that. So bonding costs in accordance with the terms of the contract, they're allowable. Bonding costs in general business, to the extent that it's, as they'll often say, sound business practices and the rates and the premiums are reasonable. So you got a bid, performance, paid, advance.
Generally speaking, about the unallowable cost, the government doesn't want to have to pay for something it doesn't feel like it benefits from. So it doesn't benefit from you advertising how great you are or how great your company is, but it does benefit from you advertising for the need of people to perform this government contract. Bonding cost, the government's looking for some protection in case you don't perform on the contract. And so this conforms with the general concept of the government wanting to pay for things that it benefits from and not wanting to pay for things that it does not benefit from.
Good point. You know, that goes back to reasonableness as well.
Mm-hmm.
There you go. We're getting the panel really into this thing now. I'd like to talk about compensation for personal services. This is probably one of the most important standards outside of materials and other things. And there's a lot of, it starts with one thing, then another thing, then another thing. So there are a lot of different components, reasonableness being a big part of this, and you're going to see how it plays out, as well as allowability in this. They expect it to be performed in the current year. So when you see expenses that the auditor does that for whatever reason, if it was accrued for 17, even though they see them paid in 18 or that kind of thing, or for some reason there's a mix-up or something, and it's like a 17 cost that hits in 18, but they kind of kept the books open, or maybe they didn't do a good enough job and it was missed. You can say, well, it's allowable, it's unallowable, it's allowable in the prior year, but it's not allowable in the current year. So, they want salaries and all compensation to be performed in the current year. They don't like retroactive payments in prior years. However, if there is something that's still open and you see that you missed something, you may have an opportunity to put it back in, but you're going to have to recertify. Total compensation must be reasonable. So what they're beginning to introduce the idea is that they'll break down the compensation as the base salary. Then they'll talk about, adding up health benefits, which generally are not a problem and always on a rise. But there'll be special things for executives like deferred compensation plans and so forth. And they'll be adding that in, as well as bonuses. So we'll look at that. And of course, it's always, the government doesn't read minds. You got to have written policies. And what happens with a new or emerging government contractors, the first thing I see is they generally develop an employee handbook. And the second thing that you've got to do very quickly after, as you start, especially if you're in a cost reimbursable world, is a basic accounting manual that kind of covers and kind of ties things and put things together as to what you're doing. So this is just something to think about. And of course, an accounting manual that's GovCon related. So you got to follow your policies consistently or to be imply a practice, that kind of thing. All right. Now, I believe, especially with large entities, when you change your plan, your compensation plan or any part of it, you're supposed to run it by your ACO, especially if you're really in the DoD world. ACO is an administrative contracting officer, and in the DoD, they've got their own. And some of the civilian agencies, the procurement and the ACO are pretty much the same. And so, and if you ever look in FAR Part 42 or something like that, and you look at the duties of an ACO, I mean, it's just, it goes on and on and on. So I see the purpose for that. And it's also, they can see things in a little bit different perspective from a contracts perspective as well. So you're supposed to notify them if you're going to like change, I don't know, from a defined benefit plan to something else, then, it helps you, behooves you to notify them, to let them know.
When I was in the DCAA, we had a contractor that won a large cost type contract. And immediately upon winning that award, he gave himself a large pay increase. And he started incurring a lot of hours on this contract. This was not in accordance with his approved compensation plan, and so those costs potentially unallowable.
So now there's a reasonableness test, and we've been talking about reasonableness for some time now. And so first, the reasonable test can be based on an individual component, like a bonus or deferred comp that's given to an individual. You're generally going to see this kind of stuff applied to more of the higher level key or executive people applied. But they may look at just the whole compensation survey, because maybe you hired some people in different categories that are brand new that they haven't seen before, and they really like you to benchmark this kind of information. Also, they're going to look at things that they benchmark: similar position, similar size of company, the type of industry, the old SIC or NAICS code now, the same geographic region. I don't know. Today, does DCA still maintain a database of the compensation?
It still uses a couple of salary surveys.
Okay.
But if you have a good quality salary survey, you can rebut their position pretty easily.
Yes, and if you really get in trouble and need a specialist, we know in the DC area, I know of a guy that does an excellent job on that if you need help. And some of those people are hard to find. DCAA can challenge the initial review of facts, any element of compensation like the 401k plan, which you're putting in, but I've not seen that too much really. If it causes the whole compensation to be out of line. So these are things they start to look at. And again, when they say that there's no presumption of allowability, you have, as the contractor, the burden of proof. That's why as you establish your compensation system or something that's a little bit more unique like a deferred comp, you certainly want to get together with a specialist to develop that, but you also want support for it. You don't want to, we give this to this and this to that. I know that with bonuses, people want a lot of flexibility, but there are a lot of things you can put into a bonus plan that helps support the plan itself. That you even have a plan that you normally give it out a certain time of year or based on certain metrics or something like that. You don't have to say, this person's only going to get 10% unless as a part of their agreement, they had such a thing, then that would enter. Okay. And then what happens if DCAA does do their wonderful job, the friendly neighborhood auditor, and they disallow some things? Well, you can offset those things, but according to them, and they're saying they only want it done among employees where there's offsets at the same kind of position level for allowable items. And the limited to is pretty much everything. It's wages, salary, bonus, deferred comp. So that's not the problem, but they say it should be, you can't just say, well, one class we'd like to offset because, you didn't include this or whatever. But on the other hand, DCAA is saying it has to be, if it's a senior engineer, it's got to be a senior engineer. I'm not exactly sure that I agree with them, but that is their approach, and you ought to know that. And of course, they provide for COLAs. There's things in there where if you're overseas or you have hazard pay or something like that, they're always going to be permitted as long as someone's not paying your taxes. We all wish someone would pay our taxes, but that wouldn't be allowable. So now you get the basis of the compensation. Now, the theory that Steve talked about and Chris talked about, then we get specific to compensation. Now there's specific issues of bonus and severance. And again, talking about a formal plan between employer and employee consistently followed to imply a practice to ensure allowability. Back pay generally is not allowable unless it's something of a court order, settlement or something like that. And then the whole thing of stock options, appreciation right, phantom stock plans, and the like, dividends are unallowable. Anything that's based on the changes in stock price is unallowable. Pensions, of course, are allowable. Now, they get into something really, they want to know if you're going to accrue something, has it been funded? I think the IRS gives you 45 days.
You have to fund your pension plans by the date of your tax filing, including extensions.
Yes, that is the exact thing. Appreciate that. So, and a non-qualified plan, basically pay as you go is pay as you go. You put it in as long as you're allocating it appropriately, it looks like. So, they are concerned if you're going to change some of these plans. Again, the changes in the pension plans, will be a problem. I mean, should not basically be a problem unless it's discriminatory to the government or not consistently applied to all employees and all employee classes, or they would say is discriminatory. So just be aware of those kinds of things. If you did happen to have a defined benefit plan that reverted to the contractor, again, what Steve had talked about with credits, then it goes back to the appropriate indirect cost pools or accounts.
And if any of you have a defined benefit pension plan, you need to know that CAS rules apply even if you're not CAS covered, and CAS rules make it make recovery of pension plan costs spread out over a long period of time. So it really is it's not a good incentive for a government contractor to have a defined benefit pension plan.
And bringing that up, it's a very good issue, just the whole CAS, cost accounting standards. We tried to dedicate this presentation to not talking about it, but it's impossible not to talk about it simply because they're integrated into various standards. We'll be talking about depreciation soon, and an election there about depreciation, or the amortization or whatever. So just be aware that even though we tried very hard to keep this more to just the FAR versus the CAS, there's no way to not talk about the CAS. And when it's in here, you have to pay attention to, does this apply? Because they're saying this is the best way, or this is the way they want it allocated. But in most cases, of course, you don't have to follow it. Fringe benefits. So that's kind of right on top of compensation. And unfortunately, they get into things like rebate and purchase discount plans to employees for products or services purchased by the contractor, and it's unallowable. So we get that out of the way, as well as obviously, the personal use of anything, particularly autos. Don't do that. Don't get leases for executives. Of course, you have no choice if they've already done it. It seems to make things a lot more complicated. But what is, of course, allowable is the standard paid absences, insurance, workers' compensation, unemployment plans, long-term, short-term liability, health insurance, all that good stuff is allowable. If you weren't aware, we continue to have this compensation cap, and it went up pretty high all the way up through parts of the Obama administration, and then it got reset to 487. And as you see, it's thankfully creeping up to 525,000 now. And it really applies to the really big executives. But I'll be honest with you, excuse me, I take that back. It applies to everybody now. It really doesn't matter at this point in time, no matter who you are, no matter what position, the max is 525.
And we talked about the government general policy is not paying for things that they don't feel like they get a benefit from. Here's where the government, the government's perception of what it gets a benefit from, is clouded. There are high-end services where the people are compensated at a very, very high-end rate. The government prices itself out of that market by using a salary cap like this, unless it obtains a waiver. Please notice that there are waivers applicable to this cost, this standard. Also notice that the government feels like it's not getting the benefit of an executive if the executive's compensation is over $500,000. But when it owned General Motors, it was paying executives $1.5 million. So this is, an area where the government's perception is subjective.
Oh my. What happened? There we go.
Great, thanks guys. So before we move on, we'll get to our second polling question, and it is, what is the cost of money? Is it interest, unrecovered asset cost due to write-downs, implicit interest return on fixed assets, implicit return on leased assets, or I just don't know? So please take a moment now to record your answers. While everybody is recording their answers, I'll provide the second CPE word. And the second CPE word is return, R-E-T-U-R-N. Remember, if you want to receive CPE credit, please jot the CPE words down as they're given, because you're going to need them for the survey following our webinar. Again, the second CPE word is return, R-E-T-U-R-N.
Thanks, Jeff. I appreciate that. As you can see, what is the cost of money? Actually, there is some truth. It is the imputed value on a property and plant and equipment. It's also implicit interest return on fixed assets, and unfair, it is also the implicit interest return on leased assets. They're both included in there. It is a kind of unique thing, and we'll talk about that shortly. But thank you all for participating. The deal about contingencies is basically this: it's unallowable because you can't predict the future. You're talking about litigation that's coming up, but you don't know where it's going to go, so it's just not predictable. That's that bullet that says rising from presently known and existing conditions of anticipated costs for material rejects or spoilage rates. It's really not a contingency; it's just an estimate. So, but they put it in there. Okay, moving right along. We're moving to contributions and donations, which are unallowable.
And one thing about that, there's a quick exception I'll just mention real quickly. It goes back to FAR 31205-1. Costs of participation in community services activities, such as a corporate fundraiser for a man-made or natural disaster assistance, where you put a coffee can in the break room and you have it in your policies and procedures manual that you will match dollar for dollar, that would be allowable.
Thank you, Chris. So the cost of money is the imputed cost of interest on borrowings pertaining to property, plant, and equipment. The basic thing is that you're using this on cost type or progress payment, or fixed type contracts, or funny little schedules. A lot of us, like Steve and I, we do it, we learn it so we can show the contractors we really know what we're doing. But it's a lot of complicated computations, and if you're pretty much a service firm, you don't need to do it. Of course, if you waive that ability and don't put that in a cost proposal or price proposal, then it's going to be waived forever. But trust me, without going into more detail, if you're really a service firm and you got a lot of leases and very little, property, plant, equipment, you would be just wasting your time. So, but it is something for like a Lockheed Martin that's building lots of things and has a lot of PP&E. Depreciation. Depreciation, of course, is allowable and generally is allocated as an indirect, maybe under the cost accounting standards. You may have some usage rates and things like that that's a little bit differently. You must comply with, if you're full CAS covered, with CAS 409, and you can elect, if you're not covered by full CAS, to follow that. But once you elect to stay, you have to stay with it. So just something to think about. What's interesting is, although fully depreciated assets are not permitted, you can negotiate upfront through an advanced agreement a reasonable charge, because you just have some great machines that just seem, especially in the manufacturing world, last for a long time. So, and we know that ASC 840, which is going away soon on capital leases, that the capitalized value of assets are distributed over the useful life of depreciation expenses. But there will be soon a new one coming in that will change a little bit of that. The sale and lease back is not a smart thing to do. I would never do it, because you'd be limited to the cost of ownership or if they retain title. And it's the same for related parties, effectively. Employee morale, health, welfare, food service, and every other thing. Generally, if it's to improve the work conditions, that's great, and it would be supported. So I guess now we talk about wellness or fitness centers, and those are important things to have. But gifts to employees, nah, they're not allowable. Achievements award are okay if going along with the plan or policy. Some of the recreational costs may not be allowable unless the goal is to, really develop teamwork and things like that. Sometimes what we've done is I've seen firms that they will not have a holiday party, but at about the same time they have achievement awards. So, and they celebrate that. Of course, we know that entertainment is just simply not allowable, no matter how you look at it. So if it's unallowable under this section, it cannot be made allowable under some other cost principle. Fines, penalties, and mischarging is unallowable. That's the way it is. Gains and loss on depreciable assets. Basically, it's the gain or loss is the difference between the net amount realized and the undepreciable balance on the asset balance of the asset. Excuse me. The credits are going to go back to the cost groupings as well as the debits. If it's an increase either way, plus or minus, it goes to those cost groupings, or what we say, cost centers. Idle facility and idle capacity is a unique kind of thing, and actually, the new ASC 842 gets into that because it talks about impaired assets, but it's the same concept that if you have a lease, and you've seen probably yourself that office leases come into being, and sometimes you take on a few extra offices that you're not going to use, within the hallway or whatever because you want the whole space. Well, that part of that, the government, again, does not want to pay for. Now, there's certain things. There's idle capacity that's less than 100% of unused capacity of partially used facilities, or it's just completely unused facilities in excess of your current needs. And so they kind of define, it's generally unallowable unless it's the fluctuations of the workload, or they've been acquired but now are idle. They generally give you about a year to deal with this thing, or you've had certain leases that you're stuck with because something has ended. And that's where you need to get back with the ACO, if you have an ACO, to work out some of those issues. But widespread idle capacity is akin to idle facility. R&D and BNP generally are allowable. They used to have caps many, many years ago. And thank God, except unless you're gigantic or something, you don't need to really focus too much on that. And so what I would say is if you look down at the bottom little thing, they say that for R&D under the DFAR, there's a limit of 1.1 million exemption before providing support to the Department of Defense. And I know Chris has something to say.
Well, I'm just going to say that, the only unallowable exception to this rule is that costs incurred but not claimed in a prior fiscal year cannot be recouped in your rates as far as R&D and BNP costs. But that just makes sense. That's what you call the matching principle.
Thank you, Chris. Insurance indemnification, generally, it's allowable. Okay, it's again the premiums, the rates, and so forth, according to sound business practice, which are the words they use. You're going to get it, but it gets into something very unique when you do self-insurance. And when you deal with self-insurance, I don't care if you're an itsy bitsy contractor. Of course, I don't know why you would do it if you're an itsy bitsy contractor, but you would have CAS 416 to deal with. And you'd also have to comply with FAR 28 insurance programs. So basically what the government's saying is all your claims for self-insurance, the administration of all that in a particular year can't exceed what the value of the premium would be. So you're still dealing with an insurance broker in some way or another to get that kind of information, and trying to pull that out of a contractor when you're doing analysis sometimes isn't so easy. But you need to be forward thinking on these kinds of things if you really want to cover it. Key man insurance, that is insuring of someone who is really a person that gets new business. That type of person is so valuable, or leadership, and if should they die, the organization suffers and the organization would get money. They know their family will have their own insurance policies, but the beneficiaries, the company, that's unallowable. And there's some other things in here you can follow along as to allowability and allocability. All righty. Interest. Well, we know that interest is simply unallowable. Cost of financing, refinancing, bond discounts. Chris?
Yeah, well, I just have something to say about that. Effectively, bank service charges, when you talk about, interest and other financial costs, bank service charges are allowable costs. And just a thought on that. Earlier, we were talking about reasonableness. Well, let's just suppose that there was a partial government shutdown and it lasted, let's just say, 6 weeks. And let's just say that you had your staff was idle and you needed to borrow against your line of credit in order to make payroll to keep these folks employed while the government shutdown was taking place. Would it not be reasonable to go back to the government and charge the interest on those borrowing costs? It would be reasonable, but you can't do it.
Sad but true. Well, lobbying, political activity costs, dealing with the executive branch, the legislative branch, whether it be the federal or state or local, is all unallowable. And basically, anything that you're promoting of a cause, an idea to influence elections, to get the people in, to get the things that you want, or whatever, those are all unallowable. And you should be very careful to read this if your organization has that. those would be probably the top 100 or so of the organization. Of course, they're probably getting probably 2/3 of all the government contract money, but if you are with a very large one, you would know that, and that's something you would want these people to fully understand, because they really are not very good.
But for smaller contractors, you find that there's a lobbying portion of the professional organization fees that that you get billed for. Those lobbying costs should be removed from your claims and billings to the government. So
That's
when you
true.
come to the American Institute of Certified Public Accountants, your annual dues would include an option to pay some lobbying costs. Those lobbying costs would be unallowable.
Right. So the only allowable exception to this rule would be costs associated with testifying before the Congress. If you were to be pulled in that type of capacity, then the costs associated with that testimony would be allowable.
Yes, that's very good, Chris. I appreciate that insight there. Yes, definitely. And there's some also like research things under the IRC, the Internal Revenue Code, that we didn't put in here that are also permitted, like social, work in terms of research and so forth. Those kinds of things for research groups that the government has paid for, those too would be allowable under the IRC code. All right, moving along here. Whoop. Losses on other contracts. Obviously, if you have losses, the government's not going to pay it, or because you had a ceiling rate on your indirects or other kinds of things that cause that loss, sorry, but the government's not going to help you on that. And this is where although there's a subtle thing behind this, and that's the biggest concern that the government contract auditors have, and that is simply mischarging and moving from like a fixed price contract that's losing to a cost plus contract where there's money still left. And there's always that fear the government has. Material costs. Yes, this is a very important standard. We probably don't speak enough about it. And of course, it's just materials are raw materials, parts, subassemblies, components, manufactured supplies, subsystems, subassembly systems. Was there something? Okay. Material costs included a reasonable overrun, spoilage, or defective work. So I have seen at some of the places they have what they call spoilage rates, scrap factors, and all kinds of things. Basically, it's just kind of like a factor is a mini cost center or something where they track. Hopefully they track it. It's not a swag, if you know what that is. So it's a real estimate based on historical stuff that they use forward. But unfortunately, some of the people that do it, they don't really take a lot of attention to it. And they say, well, it's a 3.5 or a 2. You got the information there, use it. And so I don't blame the government for challenging that, but there are usage rates that are in there for spoilage and scrap. And then, of course, always consider the fact that if this is another concept, refunds, rebates, you get discounts in material, like for the example, in terms of supplies, if this was a supply, you go to the office supply store, they give you a 10% discount through the whole year. And so for that month, you spent 1,000, well, you only record 900, but that 10%, it should, really be 1,000 that you record, and then you apply the 10% and reduce it. Now, for GAAP, it may be somewhere else under miscellaneous revenue, but when you do these incur cost submission, these types of things need to be applied. When you get to larger multi-business unit, intra or intercompany expenses, then there's a very important thing, and that is what happens to material, supplies, services that are sold or transferred between affiliates under common control, transfer pricing, distribution. It's basically cost. Everyone wants price. So if you can say that it's, other than cost for commercial work, or it qualifies for some exemption, and you're an expert and you say the price, is not determined to be unreasonable, you might get it through, but don't expect it to get through. And this is a big deal for some of the big entities. Organizational costs. Basic organizational costs is you're setting up an organization. maybe a new company. You've got one entity that's manufacturing services, and now you say, hey, I got to spin off. I'm going to set up a separate entity for services to help repair and maintenance some of the things I'm either selling under the manufacturing or something like that. To set up that service company, all the costs, the accountants, the lawyers, everything is unallowable. Government's not going to pay for that, or reorganization costs. Yev.
Yep. Thanks, Paul. So we're now on our last polling question, and that is, what is your biggest concern with consulting costs? Is it finding the lowest price consultant? Is it finding the highest quality in services? Is it retaining the consultant agreement? Or the fact that only 1 year of performance is allowable? Or is it all of the above? So please now take a moment to answer. While everybody's recording their answer, I'll provide the final CPE word. The final CPE word is cost, C-O-S-T. Again, the final CPE word for today's webinar is cost, C-O-S-T.
I know this is a question that's probably wide open, and so people kind of would interpret it a different way. It's not all the above, for sure. It is actually retaining the consulting agreement. And you might say, why? We have had more problems over my career, and this is not only for for-profit commercial contractors, but also even grantees. For some reason, I'll never understand why, consulting agreements seem to disappear. And so we'll talk a little bit about that under the consulting standard. So other business expenses, as you see below, they're allowable. You can read that. Let's see if we can get this thing to work. Okay. Whoop. Plant protection costs, of course, are going to be allowable to the extent, you know, that they're reasonable and necessary and so forth. Like I said, necessary expenses. Okay. Patent costs, generally, if it pertains to the government contract, which usually doesn't interest the government contractors because, you know, it's just the government's thing, then fine, it's allowable. But if it's your own patent cost, which you would love to have covered, but the government unfortunately is not going to pay for that unless it's just general advisory services, you know, to give you some basic background. Pre-contract costs we talked about before, and basically it's like a letter contract. We've got to get this thing going. They're going to limit it. They're not going to give you, maybe all they give you is labor for 90 days. So you got to stay within those narrow parameters, and of course make sure it's signed and everything else before you even start, or you're working at risk. Professional consulting costs is just that. You've got consultants, and therefore those services, whether it's allowable or unallowable, is really what it says. It kind of is, it depends. And there's a lot of different criteria. Although you can see under the unallowable things, to do things that obviously improperly obtain, distribute, or information, data protected by law or regulation. And it goes on, obviously lobbying costs that are in there, violating a statute, a conflict of interest, are not consistent with the purpose and scope of the service contract. Again, I cannot emphasize, and this would happen especially if you have like field offices overseas or just field offices around the country, and they have a consulting agreement but it disappears, and it really it's really a sad thing.
You know, what I see with hiring consultants is that some department, the person hiring the consultant gets the consulting agreement, and the invoices go to accounts payable, but the consulting agreement never gets into the AP file.
Yeah, that's the problem.
Yeah, and so the hirer has this document that's important to retain and use to support the cost, and it gets buried with his records and forgotten about.
Thanks. So one of the things, the bottom bullet here that I think is so important is that basically the 4 things that a consulting agreement should have. It should describe the service, the estimated time, repaired performance, the rate, and termination provisions. Those are the minimums for that. And here it goes in again to just the documentation requirements, evidence of the nature of scope, retainer agreements, evidence of determining the work was performed proper, doesn't violate. But on this one here, it gets into the details of all agreements. Chris, you have something to say?
Yeah, I just wanted to go back to the polling question real quickly. The 8% of the audience suggested that lowest cost was the criteria when hiring professional consulting, when obtaining professional and consulting services. And just so you'll know, as a former DCAA auditor once told me, DCAA rarely questions accounting costs. In other words, they're allowable. So the price that's being presented to you for an audit or a review, tax return, or any kind of consulting that Paul could provide, for example, they're allowable, they're recoverable. The government wants you to spend money to get things right.
Okay, thank you, Chris. Okay, recruitment costs generally allowable. There's a lot of information about that in there. Help wanted ads are certainly allowable, but the part of the help wanted ads that are not allowable is when you start putting in other things like promoting your organization and that kind of thing. Relocation costs, there's a lot of information on that. We could not put that in. That would be like just one session on relocation. But we would tell you that if an employee terminates or resigns on their own volition, then all their costs, if they've been there less than 12 months, is unallowable for relocation. So think about that. A lot of people make agreements, and I would not prorate it, I would say, because technically it doesn't say that in the regulation. I would just simply say, you got to pay it back if you don't stay here for whatever years, at least 1 year. Under rental costs, it's what's the obvious. When you set up a rental agreement, did you look at comparative property? Did you do all these things that are available? And smart people do that. If you didn't, you wouldn't have a business. You wouldn't last very long, but it is something that's in the regulations against sales and leasebacks, and under common control generally are not things, well, sale and leaseback, you're not going to make any money. They're going to limit you to the net book value of the asset or the title of that property when it was originally, when it was handed over. And charges in nature of rental property between divisions, it's limited to the cost of ownership.
Yes, and Paul, you had mentioned earlier in the presentation ASC 842. That's a game changer. It's going to take effect for most companies, if not, actually all companies, on January 1st of 2020. In a nutshell, it requires lessees to put most leases, including facilities, on your balance sheet.
So royalties, basically, again, determining patent rights and royalties and so forth. If it applies basically to the contract, and it's a result of and it hopefully has an arm's length bargaining, and it was properly accounted for, that would certainly be allowable. But the point is here is it's for the benefit of the government. So specifically royalties on patent amortization, it's unallowable if basically the government already had the lease, the patent is invalid. Boy, that wouldn't be fair. Unenforceable or expired. So you see, they're trying to cover everything that they can. There are many different types of selling costs. We've talked about unallowable advertising and PR, and bid and proposal cost is allowable, economic planning. What I just want to leave you with is some information on direct selling, that it is allowable. It's basically to induce particular customers to purchase products and services, that person-to-person kind of contact. And what you're doing is you're negotiating, liaisoning with the people, and technical and consulting activities and individual demonstrations. All that, as I said, if you had an exhibit you built, if you had special brochures that are expensive, if this is the only way it's being used, it would be 100% allowable. Or think of it this way, build the exhibit, meet with the people before year end, and then in the next year, there's nothing they can do, and then take your exhibit to the trade show. Ha, 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 DCA. Okay, well, we just have a few more minutes. You know that federal income taxes are unallowable. State is allowable as long as they're paid and accrued in accordance with GAAP. We're just not going to have all the time there, so we ask you to look at it. The one thing you need to know about termination costs is that there's special treatment of costs that would have not risen had the contract not been terminated. So once they terminate, it's usually the beneficial one's called termination for convenience. And once that has happened, basically everything changes and how you cost things change. And I encourage you to read over this stuff if you get into that situation. Trade, business, technical, and professional activities are allowable. It's the technical and professional dissemination of information. All of that's allowable. Like you belonging to a chapter of the AICPA, that's allowable. All that stuff, the brochures, everything allowable. Training and education costs. If you're helping an institution, another institution, that's unallowable because that's like a contribution. There are limitations on college work and for full-time college work, education limited to postgraduate. That's looks like it's limited to 2 years. Travel costs is the last big one. So we're starting to wrap things up here and get into our questions and so forth. But basically here, the cost of transportation, lodging, meals, and incidental costs. So the way the government looks at it, you can use a per diem basis, you can use an actual basis, you can use a combination. But when you're on a contract, you're going to be limited to the JTRs, the FDRs, and so forth. And you remember that if you travel basically, and it's during the day, it's not, it's part day, a lot of those use the rules of 75% of those per diem, the meal and incidentals. And so those are things you need to know when getting into that. One last thing I would say about lodging, a lot of people include the local sales tax. You do not have to do that. When you're evaluating, if you look at their regulations, the FDRs, it's the total lodging before taxes. That's what bounces up with the cap on that. And if you're having problems, talk to your contracting officer or the ACO on that. See if you can get some relief, because sometimes those things are just ridiculously low. And here you can see an example of a meal expense, and still the policy there, if you have expenses under $75, I guess receipt is required, right? Or not required, under $75. Not required. But still, they'd like you to fill out the form and so forth. If these are for meals now, well, it says everything, but if I was there, I'd still want to see the taxi ride, even if it were under, those types of things. So every organization is going to have to set up their policy.
There's a business purpose for getting the receipts. It also makes a lot of sense to have your travelers paid per diem so that they don't have to keep track of receipts.
There you go. Excellent. All right. And we're going to just move along here to make sure we stay within our time limits. Goodwill is under the purchase method where after you bought everything, you're paying a different, fee, a markup on the assets, and the government's not going to allow you to pay it, no matter how you amortize it for a gap. It's unallowable. And alcohol beverages are unallowable. And let Chris speak first, and then you can speak. Chris.
Yes, Steve, thank you for educating me on this fun fact that I'm about to share with the audience. And the allowable exception is found in FAR 31205-1, Advertising and Public Relations, and to wit, costs of keel laying, ship launching, commissioning, and rollout ceremonies to the extent that they are provided for by the contract. So therefore, that bottle of bubbly that gets smashed against the hull before the ship or submarine leaves its slip, that would be allowable.
Okay, and Steve would say yes.
Yep.
Okay, there's also one on business combinations, and basically, let's see, it's tangible capital assets when with the purchase method of accounting is whether or not contract or subcontract is subject to CAS, the allowable depreciation and cost of money shall be capitalized based on the capitalized assets value measured and assigned in accordance with CAS 404. So, otherwise unallowable, right?
Yeah. So when you're buying a company and you purchase the assets are revalued to fair market value. The government feels like it's already paid for those assets with the prior contractor, so it doesn't want to pay for those assets again. So the net book value of the assets transferred is the cap on capitalization of those assets acquired through a purchase of another company.
Okay, thank you very much. And now we're going to turn it over to, if I can get the slide, there we go, to Yev.
Yeah, thanks, Paul. Thank you, guys. That was really good information. So before we wrap up, and I know we're a little close to the end, so we appreciate everybody staying on board with us. We have a few really good questions that I think will be helpful to everybody. So with that, Chris, how should we treat project management costs when we're not allowed to bill for them? I mean, would those be unallowable since they're not directly billable, or should they be charged to overhead?
Well, it could be none of the above. I can tell you on good authority, they're not going to be unallowable just because you can't charge them. Now, if they are specific to if these are project or program management costs associated with a project, so it's clearly identifiable to a project, but not billable, then they'd be classified not as overhead, but direct, not billable. So that is the answer. Direct, not billable, but certainly not unallowable.
Okay, got it. That makes sense. And Paul, what about employee morale costs? So things such as holiday parties, corporate retreats, company picnics, are those allowable? I mean, all those things except for the alcoholic beverages, obviously.
Generally, they're still unallowable. Probably, I know it doesn't say it directly. It's kind of the way DCAA interprets it. That's why for the holiday parties or even a picnic in the summer, you know, make it an award ceremony or something and then kind of do the same things.
Okay, definitely. Got it. And finally, Steve, where can we find the guidance for leaving unallowable costs in our G&A allocation base? In other words, not fragmenting the base.
It's found in a couple of places. The primary source is CAS 405, the unallowable cost standard. It's also in the first part of FAR 31, 201 through 4 is going to address not fragmenting the base and including unallowable costs in the appropriate allocation basis.
Okay, excellent. And now we actually have time for one more question, and I'll pose this to all of our speakers. Are team lunches or taking a new employee to lunch, are those costs allowable?
We did a big study on that one time, and there's very little, there's not as much room for allowability of meals as you might think. There's been a number of cases that have severely restricted them. You need to think of lunches as a potential source of entertainment, and make sure they're not extravagant. Make sure that there's a valid business purpose that the government benefits from. So on one hand, if the executives go out for a nice dinner after a board meeting, that sounds like an unallowable activity, both in amount and business purpose. On the other hand, if a traveler is on the road, certainly meals are part of his allowable travel cost. If the pricing team is working late into the night to get a proposal out, and you buy pizza for them so that they can work beyond midnight, that seems to be allowable and reasonable business expense.
Okay, got it. No, that definitely all makes sense. And again, I appreciate all the great information. And we'd like to remind the audience that if you all have any additional questions after today's program, feel free to reach out to us. All of our contact information is listed on this slide here. And so with that, we'd like to thank everybody for attending today's webinar. We encourage you to always check our website for any upcoming events and updates at www.grfcpa.com/resources/webinars. And again, please remember to complete the emailed survey that follows if you'd like to receive CPE credit for attending today's webinar. Thank you all once again, and we wish you all a great day.